is now starting. All attendees are in listen-only mode.
Welcome to the Global Corporate Venturing webinar. This analytics review is looking at the media sector, and it gives me great pleasure to start off with the look at how the media sector is both investing in corporate venturing deals and also what's happening more broadly from outside investors coming into the media sector. And I'm delighted for this podcast. My name is James Mawson, founder and editor-in-chief of Global Corporate Venture, and it gives me great pleasure to welcome Tony Askew to the webinar. Welcome, Tony.
Hello, James. Thank you.
Welcome. And obviously, as you can see on the screen, so Tony is the founder partner of the REV Venture Partners, also known as the, formerly known as the REV Ventures, the corporate venturing arm of one of the world's largest content technology and analytics companies, RELX Group. And he has 25 years of financing and building digital media and technology businesses, and is a board member of various startups, and also has been the chairman of the Venture Capital Committee of the BVCA, which is the British Private Equity and Venture Capital Association. And I think, as is traditional for people going into the hard sciences such as physics, after graduation, he went and became a management consultant before joining, I think, SoftBank. Was it, Tony?
Yeah, I was in SoftBank the last time Masayoshi Son was deploying a huge amount of capital globally. Yeah, absolutely. That was in 1990.
Some things never change. It's just cyclical.
Exactly. Exactly.
Okay. Well, delighted you've been able to join. Just a little bit of context about Global Corporate Venturing, how it fits into Mawsonia Publishing Company, before we get into the media data itself. But Global Corporate Venturing is just part of the suite of titles we run within Mawsonia. We do Global University Venturing, looking at how student and faculty startups and spin-outs are funded, primarily for the universities themselves. And we've also been developing and launching Global Impact Venturing, looking particularly at how corporations are using an impact lens through the United Nations Sustainable and Development Goals in order to find and change the world, and hopefully for the better. And as well as the publication Global Corporate Venturing, which has a website and the data which forms and flows into GCV Analytics. We also do a training academy run by Paul Morris, and all flows under the GCV Leadership Society, which are now members and others within the ecosystem to come together at the events that we publish and produce. We do continent-wide ones in North America, Europe, Asia, and Latin America. We've just completed the Euro one. That was the GCV Symposium held last week. The symposium, I'm delighted, Tony, to catch up with you there, alongside about $2.5 trillion of aggregate annual revenue from the 400 plus corporate venturers who attended, which is about the size of UK GDP as it happens. And next up, we've got the Corporate Venture in Brazil and Asia Congress coming up in the autumn, in September and October time. And then we'll roll round into Monterey in California for the next GCVI Summit. As well as that, we do a number of obviously regional and sort of sector focused ones, such as Houston for our oil and gas and energy and mobility, Israel, and a number of Connect meetings for the Leadership Society members. So for those who are interested in learning more, GCV Analytics has been developed through our software developers in Silicon Valley called Cubix Analytics. So thanks to Jeff and Tim and the team there at Cubix for helping us showcase some of the data that comes out of this ecosystem. So over to the media sector itself, and I'm delighted that we've got Tony on board, because the media sector is actually pretty broad, as well as the sort of what you would expect in terms of audio and video and sort of online content. We've got games, gaming, esports, which has been growing rapidly, the social media networks, which has been particularly disruptive over the past decade or so with things like Facebook and WeChat, and then the print and online publishing, which has been traditional, sports, entertainment and gambling. And then I think one of the areas that we've found particularly interesting, if still perhaps a little bit nascent, is the virtual and augmented reality. We had a closed round table last week at a symposium on that, and I think Tony will ask a few thoughts and a few bits of feedback from you on that sector in particular, as well as other media products and services. And then the general trends in the sector, I think there's been a number of issues. In some ways, the media sector is sometimes at the first port of call for some of the disruptions happening in technology more broadly, whether it's the new technology such as the rollout of 5G for telecommunications, obviously go further back, the development of the internet and then social media, and the fact that great content is no longer enough. Content might be king, if you look at what Disney's been doing, but it's moving more towards living services as a concept, and further digitalization in the sector to unlock perhaps what some consultants estimate to be $1.3 trillion in value by 2025. So major trends and themes such as personalization, contextualization, content fragmentations and partnerships, and industrialization, disruptive use of artificial intelligence, and digital advertising spending expected to overtake traditional ad spends by the end of this year. So Tony, I'll just sort of, within that sort of wider brief, there are some other trends as well, such as VR and AR and growth of mobile gaming, esports, and privacy. Do you have any particular thoughts yourself of how you start to sort of segment and look at which factors are most important from your perspective, from REV Venture Partners or within the wider parent company at RELX?
Oh, sure, James. So hello, everybody. It might actually be worth just articulating the journey that RELX, who's our single LP, has been on over the last 20 years, as well as give you a quick background on us. I started what was then REV Ventures with my partner back in 2000 during the craze of the dot-com boom. And we started to invest then in content re-platforming technologies. And at the time, Reed Elsevier was largely a print-based organization. So you talk about these themes of digitization. Reed Elsevier realized back in 99, 2000 that it needed to massively transform its business. It was mostly print. Half of that was driven from advertising. And it recognized that the days for those were kind of numbered. And our initial view of the market as Reed Elsevier Ventures was to help what was then Reed Elsevier on its transformation to become digital. And it's since moved way beyond being digital. I mean, I think over the last 20 years, you've seen it go from print to digital, from digital to analytics, and then it moves beyond sort of base analytics through AI. And into very sophisticated kind of in situ, in work stream sort of analytics. And over that period of time, Reed Elsevier has changed the nature of its company. So it's moved from being, as I said, more than 70% print to way less than 10% print and almost no advertising over that period of time. And it really, I think, RELX led the entire information and media sector in completely transforming its business model, its go-to-market, and its entire technology stack. It now operates very sophisticated, data-rich, real-time data tools, services, and outcome-generating analytics software, operating across banking, insurance, threat detection, fraud detection, as well as some of the core areas that people will have remembered Reed Elsevier from, such as legal information, where it's leading the charge in legal, around the application of AI and machine learning to legal decisions and legal research, and of course the scientific industry, which is still very similar to as it was 20 years ago in terms of its consumption of information, but it is right on the cusp now of really being a very strong consumer of very high grade analytics and data architectures. And I think that's where you can see, I think, a lot of scientific discovery is going in silico, enabled through AI and machine learning to either amplify the humans in the process or to come up with novel ways of running in silico experiments and those kinds of things. So I think each of those divisions have experienced a huge transformation over that period of time. So that's kind of what's happened to the LP, and we have been part of that journey across that whole period. And as I said, the initial period was around content replatforming, and we invested in things like natural language search, peer-to-peer content networking, then into unstructured data management, and then into structured data, and became an early investor in very important sort of structured and unstructured initiatives, including Palantir, which we're very pleased to be part of. And that process has continued for us, such that we roughly around about a third of our portfolio at any point in time is what I'd call foundational technologies, looking at how data, content, and the like are processed. And 2/3 of what we do is in vertical markets, starting with healthcare, and then move to education, legal, finance, and most recently we've done agriculture. And really where we stand now, so bringing some of this full circle around this digitization in the sector, is, I mean, I think we really see that now every industry is being transformed, regardless of whether it's been an information-rich industry, is being transformed into an information industry, is being transformed by software, data, and analytics. And whereas 20 years ago, the majority of the top companies in the world were the best in class across a representative set of sectors such as finance or petrochemical or pharma or some such. The most valuable, 7 out of the 10 of the most valuable companies in the world today are technology and data companies, and we see that is a fundamental trend that is pushing on. So our mandate is continue to refresh 20 years in, because the world which Reed Elsevier, now RELX, operates in is seeing, RELX has been a thriver from that transformation to digital and beyond, and now it's seeing each of its customers and its customer environments going through that same transformation, whether it's in oil and gas, or whether it's in finance, or whether it's in insurance, or whether it's in petrochemicals, or kind of wherever their customers are. Those industries are going through the same highly disruptive transformations. And I'm sure many of you listening today to the podcast are in industries which are rapidly coming to terms with the digitization of your industry, and the level of industrial analytics which are now available for every decision point, and a huge amount of data and analytics now which are being used either by insurgents or your competitors to heavily disrupt the traditional methods of working in your industries.
Yeah, I think that's a fantastic point, Tony. I think we'll see it in some of the data as we roll through into that actually, we'll start off with a geographic, but as you look through into the sectors where media companies more broadly as they're defined are investing, is not just into the media space, it's into, as you described, some of those verticals, and then equally some of the competitors coming in because they see the media as an opportunity to expand into sort of new parts of the ecosystem that they haven't played in, because they've not needed either the analytics or the understanding of what the content can provide. So it definitely seems to be a sort of a trend that we've seen on that. But if we start off on the global view of the deals, these are where media corporations such as Tencent, such as obviously RELX, and Hearst and other these types of more traditional media companies such as Sky, have invested around the world. And obviously, as you can see, China, India, and particularly the US have been driving it. Europe as a whole is broadly at a similar level to the number of deals that we've seen in China and India alone, which I think is perhaps indicative of the change. Tony, do you see that the sort of shift of the media landscape has been a bit more eastward? Obviously, the US remains dominant by the number of deals that media corporations have been investing in, but do you see that sort of shift eastwards for within your portfolio, or how you think about things?
In our portfolio, not specifically. I talk more generally, I think, about the media industry, or actually global venture capital, actually, because if you go back 5 years, the US was clearly the most invested in and the dominant venture capital landscape worldwide. And within 5 years, China has completely caught it up, if you believe all the figures. Mm-hmm. And last year, roughly 90% of the investment went into 50-50 between the US and China, bar $4 or $5 billion. And unfortunately, only about 10% of it went into Europe. So that might tell you something about the innovation landscape going forward, particularly for Europe. But that's, I think, probably a subject for a different different session. And I think you've seen that mix the same with broad investment across corporates. You've seen a huge number of corporates beginning to invest 15 years ago in China, seeing some of those returns, and then more heavily piling in over the last 10 years. And media companies in particular are looking to extend their footprint, trying to shore up their footprint and work with local partners. Talking specifically around media, it is a much more challenging landscape to invest in, particularly in China. It's a very heavily regulated market. It seems strange being in the West to think about heavily regulated media, because we are awash largely with unregulated media. In China, it's heavily regulated, and we could have a whole podcast today about how to make media investments in China work, which would be very hard, because you're facing all the time the scrutiny of the legislature. You need to work with the government. You need to be very closely aligned with local PRC nationals, and typically you're either joint venturing or handing over significant control to locals. So pure media deals are much harder to do. Consequently, a lot of media companies are invested in technology companies, ISP type companies, which is essentially the technology and the underpart that operates a content service, but not allowed to invest in the content. So there's been a number of workaround plays to invest in classic media companies in China, and most famous of which is obviously Naspa's investment in Tencent, which is done super well. But the other striking thing I think about China in particular is how quickly corporate venturing has taken off by the new emerging technology powerhouses in China. So pretty much every single company that gets to a decent size in terms of market capitalization starts to invest its profits, or its notional profits, or at least it's some of its market cap gain, via a venture fund into local market participants. And that's very much a different reason than traditional both media and non-media corporate venturing. Traditional media corporate venturing is really around having the sensors out there for how the future market is going. It's market sensing activity almost primarily that is more recently backed into sort of more scale business model type investments. In China, it's really around ensuring that the ecosystem is vibrant around the media stroke technology products. And so each of the majors, as you know, from Baidu, Tencent and beyond, have all got very, very vibrant and very large scale corporate venturing activities, which has meant that almost in order to compete, one has to, in China at least, be an investor as well as a market participant, which has been somewhat different as the nature of the Chinese market than the US, where the notion of corporate venturing in the US at least has been around market sensing and trying to better understand the way the future is going in terms of innovation, whereas in China it's much more around doing that plus shoring up the present ecosystem.
That's fascinating, Tony. Yeah, I mean, definitely. I think we had Jeffrey Lee, who's the managing partner of Tencent Investment, speak last week in the Symposium, and he described that they've got a free cash flow of about 10 billion per year, and almost all of it goes to Tencent Investment for corporate venturing and or M&A deals, which is just a sort of mind-boggling amount, really, compared to sort of traditional venture. I mean, that is bigger than the venture market in almost any country outside of the US, pretty well much, and that's just from one corporation. And Alibaba and Baidu are not far, or if not the same, in terms of scale. So it just points to a different sort of land grab or different opportunities as the country grows and develops, it feels like. And do you feel that India's the same from your point of view? Do you see a slight difference? Again, your focus has been on the sort of Europe, Israel, America primarily, but just as you listen to your portfolio companies, as you scan around the sort of the global venture ecosystem, do you feel India is turning a bit more like China, or has more of elements like the US has had?
Yeah, so we have not historically invested in outside of the US, Israel, and Europe, and the reason for that really is around the need to construct a sort of local market presence, which takes you into kind of almost like another category of venturing. You need to hire a local team. You need to have you know, the local, I think a lot of local market participation. I looked you know, a dozen years ago at how we could potentially do that. It's very hard, particularly when the barriers around, as I mentioned at the time, were much more heavily media, are so prevalent. I think it's been easier for companies which have got much more collaborative correspondent assets to make those inroads much more heavily, because they're kind of you know, like the Intels and Microsofts of this world, which are essentially technology platforms, which the Chinese government in particular kind of wanted to work with. So I think there's kind of each industry's had its own issues about how it's moved there. That's so from a portfolio basis, we haven't made investments in either India or China. However, our companies have. So
yeah,
you know, each of our companies have done various activities in India and China. And in fact, one of my company is called Edcast. The CEO, who is native-born Indian, Carl Mehta. Actually, we have quite a lot of customers in India. We have a subsidiary in India that employs a lot of our technologists, and actually we have a go-to-market sales force in India, and that business is growing rapidly. So you know, I see a couple of other of our companies over the years have had effective operations in China. I was on the board of a business which was an information company for electrical components in distribution, and the majority of our market was actually in China, and we established a very large broking business and distribution business in China. That was 10 years ago or so. But as a fund level, we have decided to stay much more focused on, largely I think for us, because we are much more focused around the market sensing activity than anything else for RELX, given the massive journey that it's been on over that period of time. That the next journey that it's going on, which is kind of very sophisticated analytics and deep artificial intelligence, machine learning, you know, what we call the human-machine combination. We still think that the majority of that IP is being developed in the United States, and unfortunately most of that is still being developed in Silicon Valley, but not exclusively in Silicon Valley. And so therefore we get, for a smallish fund, smallish group, we get a much bigger bang for our buck focusing on Silicon Valley and the US market primarily, with a little bit obviously in Israel, Tel Aviv, London and Berlin, than we do focusing kind of very, very broadly internationally. I mean, we're one of the few funds that operate those three territories from one location, which is London anyway. So spreading ourselves even more thinly with further cultural disadvantages would I think would be much harder for us. But as I say, the main mission here for us is market sensing.
Yeah, I think we'll come on to that sort of human-machine combination in a bit. I think it's a fantastic area. I'd love to hear a few more of your thoughts, Tony. So as we sort of look down, I think this very much plays into what you were mentioning before, which is that, you know, where the media corporate ventures have been going, obviously the majority of the deals have been, or a good nearly half of them have been in the media sector itself. That's sensing what's happening to advertising technology or marketing, you know, what's happening within sort of content and distribution, games and AR and VR. But some of it is going outside and drilling down into saying, what does it mean, you know, in different services or IT platforms, and then into the different verticals such as financial, consumer and health. Does this sort of play, does it feel like there used to be an old saying that, you know, everyone's software's eating the world, but everyone's in some ways a media company now, because content is so important to be able to reach the customers, that direct to customer. Are you getting that sense yourself, Tony, that people look into you and the sort of, it's not just about the information, it's the analytics, it's what can you do with this information, which fundamentally used to be what the content was about. But are you seeing that people coming to you and asking for your advice more from these different sectors?
Absolutely. That's I think one of the biggest trends over the last period, certainly the last 10 years, and more broadly over the last 20 years, is as every company it kind of needs to redefine itself as an information company, because that's where you get the value add. That's how you kind of better utilize all of the resources across the enterprise. Whereas 20 years ago, technology was usually done as a sort of an afterthought, as a kind of an addition to a product line, or as an enabler of a product line, or as a channel to market of a product line. Now, you can't conceive of creating a product in most of these categories that you have here without a fundamental technology platform that you're basing it on. And of course, the media stroke information industry was the first to reinvent around that. It reinvented the nature of the way information was created. It reinvented around new sources of data, which could then be combined into rather real-time sources of information, or as raw data with a movable lens, which is now the analytic environment or the AI environment over the top of it. And once you abstract the medium from the message, so to speak, you suddenly have every industry vying to understand how it can use its data more effectively, and actually calls into question the role of a media stroke information company, in my view, because as every industry reinvents to become much more as an information company, traditional boundaries of what is an information company versus or a media company and what is in a traditional industrial company start to blur somewhat. And people used to talk about information exhaust getting kind of reused, and obviously very famously, that's how Google went from being an enterprise software company to that was a best advertising company, because it started to use this data exhaust, the database of intentions, as they called it, of what people were looking for. They started to turn that around as mirrors on behavior, and were better able to price behavior. And that core concept of being able to price behavior, understand and price behavior, is exactly what is driving this curve you see here. One of the reasons why media is investing and everybody's investing is because behavior is the kind of the new oil more than it is data. And behavior across all of these sectors mean that you can better understand what your customers are doing, whether it's in the healthcare industry, better understand the passage of your patient through the healthcare system, hopefully with a very positive outcome, which is where that industry is focused, is all around outcomes of patients, or whether it's in industrial, where the outcome there is better use of human time to produce output for, if you can improve the workday of an engineer by an extra hour, you've almost added 25% to the production throughput of industrial. Or if you remove further delays in production because you've better aligned software, automated processes with the movement of massive machinery, again you get these massive outcomes. And this is all around data and analytics. And so it's not really surprising as you start to use novel data sources which are taking either off production lines or in situ from various sensors, or maybe it's being watched from the sky because you're looking at fleets moving around the country using satellites, optimizing in terms of transportation where people are going, or if you're allowing a whole fleets of lorries to only have one driver to drive them, you're essentially using data as the fuel into your analytic environment to really transform the way in which your industry may well work in the future. And that's not a million miles away at all from where information and media companies have been for the last 5 to 10 years in their reinvention. So every industry now is reinventing around information, and it's therefore not at all a surprise that you find media companies and information companies being very active in investing in those sectors and being pulled into those sectors in particular.
Fascinating. Are there any risks? I mean, one of the things you mentioned last week in a round table was a book, The Age of Surveillance Capitalism by Cyboff, and I'm just wondering whether there's been a lot of talk about companies such as, say, Facebook, which has, fundamentally not regarded itself as a media company, said we're a technology company, and over the past few years they've been caught or pulled into various debates and discussions about fake news and whether they could do more to monitor the platform. I'm just wondering whether the sort of legacy experience or understanding in the companies such as RELX, and other media companies of navigating sort of fundamentally social responsibility and some of the ethical issues around sort of data and how information is used to affect behavior, will actually be a important differentiator compared to other industries which want to use it but maybe haven't understood some of the implications.
Yeah, absolutely. I mean, I think we talked last week at the round table, and I think I see that definitely the impending regulation across a number of industries around the use of information, and particularly behavioural information, and in every case, certainly, the Silicon Valley mantra, which is to move fast and break things, is very good and works so well in young entrepreneurial companies, and it works less well when you have industry defining category leaders that actually have a lot of that power that has come very quickly and unexpectedly in terms of how the regulator or governments would view the arrival of that power. And the same thing happened during the industrial age, of course, which is how we have what we now think of as antitrust laws. And it came around in 1910, 11 sort of period, to break up these industrial behemoths that emerged very, very quickly through the Industrial Revolution. So it's not a surprise that it's come around. I think for most people it's come around very quickly, and the conversation is still a little bit to be had in multiple areas, because there's still quite a lot of folk who believe that the technology industry, the big tech, can regulate itself. It's very hard though for industries to probably regulate itself. I think there's tremendous advantages to this flow of data, the ability to understand behavior, to track and modify how we respond to each other and society as a whole. But with that comes enormous responsibilities. And I think that we've been through a very long period now where there's been very light touch regulation, and I actually do think that regulation will become inevitable in many quarters, and that's not necessarily always a bad thing, because with regulation comes opportunity, comes a slightly higher bar that one holds each other accountable to, and actually what also regulation enables is proper regulatory scrutiny, of course, and who would I think there's a whole set of industries which are yet to kind of feel the gaze of the regulator. But certainly my personal prediction, at least, is we're going to see more and not less of it. But there's always going to be technology there's always going to be players who are moving so fast that they are moving way ahead of where any new regulator, any new thinking really is, and that's always been the challenge. That is why it attracts so many people to technology, because it is the new world, and there are so many new dimensions now. We've moved beyond that criticism that Peter Thiel had 10 years ago of, I dreamt of flying cars and got 124 characters or whatever it was he said. We are now very much in that era of flying cars. Well, maybe not quite flying cars, although there's quite a few flying car companies knocking about. We are very much in that era of the transformation of atoms, and I think you're gonna be seeing the companies moving ahead much quicker than regulation can catch up, and I think this whole privacy a data integrity debate which is going to roll for the next 20 years, particularly in sensitive discussions around, let's say, healthcare or insurance. It will suddenly become the same thing in these new in some of these other new areas. And the question of whether or not software would ever move down that line, I don't know. But certainly, I think we get behaviour. Any first-party data owners are suffering from the particular threat of the regulator right now.
Yeah, no, I think sort of one of Bill Gates's finest moves was, getting software to be removed from any sort of consumer protection issues in terms of if there's a bug in the software, well, they'll try and fix it, but there's no real consumer protection about how the software is used. And I think that from that has flowed our ability to move fast, break things, and try and then fix or patch things up. And I do wonder, I mean, looking at this slide here where you've got a number of the co-investments between traditional media companies or newer media companies such as Baidu, perhaps no longer new in some ways, or Gree and Asahi Shimbun in Japan. I do wonder whether that regulatory piece, if data, as is sometimes described, is the new oil and everyone wants the data for that data exhaust to inform behaviour and inform decision making, whether regulators will say, well, look at these combinations of large behemoth corporations all playing around these similar spaces. Maybe there's issues around underpricing the products, and therefore dumping of companies. If you think of it, let's take an example such as, say, Uber. It's had state money, maybe indirectly through SoftBank. The Saudis have invested in SoftBank. They've then invested in Uber. Uber then, in effect, underprices its taxi services compared to traditional providers in order to get market share. Now, if that was the steel industry, that would be called dumping. And it wouldn't necessarily be allowed in the way that, say, China dumped steel in the US regulators and market complained, and they charged extra tariffs on it to get the price back to what they considered market rates. And I just wonder whether these, if you look at the sort of the cross holdings between various different companies, if data is an issue, and particularly look at 8i or some of the AI companies, allowing them into a market to get market share, to get the data from what Kai-Fu Lee, who used to run Google in China and now runs Venture, talks about, is like, well, whole countries are in effect providing their population data to either American or Chinese corporations, which will then use it, and in return you might get lower priced products, but they in effect they're getting the higher value, raw, using that raw material and create a higher value added services on top. And I just wonder whether this might be a risk factor, just these cross holdings and in effect underpriced services. What do you think, Tony?
Well, it's hard to comment on individual companies,
of course,
and their shareholdings, because one doesn't know the nature of the agreements. I mean, I think in general, the majority of companies who are investing in these companies are not seeing any data exchange and are not investing for that data exchange. I think their majority, they are market. If they're Western companies, they're nearly always market sensing, and they are. These are holding patterns for the future, and they may well be acquisition targets going down the line, in which case you then that category of problem may well come about. I think the more broad question I think you raise, which I think is a very good one, is to what extent some of the companies which have gathered a lot of momentum over recent years, and you might call unicorns, are in fact are existing because of a regulatory arbitrage, and there's undoubtedly there are those which have been taking advantage of that regulatory arbitrage, moving much more quickly than any regulation can possibly catch up. And then has of course challenged that regulation. And in some instances, it's absolutely valuable and viable that a new company comes and kind of shakes things up, breaks down the traditional way of thinking, and kind of recombines it in such a way that delivers much better value to customers. And in those situations, everyone says, "Wow, that's brilliant that they've come along and done that." And then of course, for every one of those, you're going to have maybe one or two that have gone the other direction and have simply sort of ducked in under the regulators' watchful gaze and offered a product that incumbents couldn't possibly take to market, because those incumbents would lose their license or would certainly lose out in other ways. And we certainly, I think there's certainly examples of that if you look across companies which have entered markets over the last 5 to 10 years, that where you couldn't possibly have gone there being an incumbent. And again, time will tell for each of those companies. And then of course you've had what I would call grey market companies that have exist for a period of time until the incumbents catch them up and actually regulators close them down, because they are doing something that is right on the edge of something that could be seen as being understandable and sensible. And you had a little bit of that in the early days of things like advertising technologies and so on, of intermediaries being able to grab data which even incumbent data providers were shying away from being so obvious with, because of that. So I think your broad point is extremely true. I still remain relatively cynical about shareholdings. I think in general, if you were to take the business plan of any one of those individual companies and show it to one of the shareholders, I'm not sure the shareholders could move quickly enough or nimbly enough or with the right talent and with the right platforms to in any way copy, let alone have something that's competing in the market. Because it's rather like, I always think it's rather like, this the mystique that used to be around the recipe for Coca-Cola, which Coca-Cola manifested for many years until they finally let it out the bag. I think it was the end of the 80s that really we could tell anyone the recipe for Coca-Cola, because the real recipe for Coca-Cola is its distribution, its bottling and distribution. I mean, yes, the flavor's good, but without the bottling and distribution, good luck to you. And that's exactly what happened. And that's why there were two big scale players, of course, Pepsi and Coca-Cola. And rather similar is true here. It's different era, different form, but without the fabric of those companies, without that talent pool, without the technology platforms, without the know-how, without the entrepreneurial spirit, without the move fast and break things, any one of those companies on there, these are the names that I recognize, I think would struggle very much trying to operate those businesses. So I think they're much less likely to be kind of first party beneficiaries of either that data or that approach. I think they're sitting in the wings trying to figure out how they could move their vast enterprises much more towards those kinds of operating principles.
Well, fascinating. I'm mindful, just for the listeners out there, we will ask some questions towards the end, so do start writing them out and I'll read them out as we come towards. So we'll rattle through the next couple of slides. Tony, just shout out if you got particular thoughts. But as you can see, as we look, this is just the corporate venturing deals done by the media, as tracked by GCV Analytics. There's broadly sort of similar numbers over the past 4 or 5 years, at about just under 400. The value of those deals is somewhere between 15 and 20 billion or so dollars. So this is sizable money going out. This is just part of the rounds that corporations were with, so not just the money from the corporations themselves. What
I would call out on that slide, Jim, is that maps very strongly the sudden explosion of venture capital and non-traditional venture capital that happened from 2014.
Yeah,
almost half of the money that went in last year didn't come from traditional venture capital funds. It came from mega rounds from these pension funds, offshore funds, mutual funds, some sovereign wealth funds, and the like, and of course corporates, and that falls. That's right in that same trend line. Up to 2013, there wasn't much change for about 10 years, and then after 2013, it's just exploded.
Yeah, no, definitely, and I think it's part of this sort of the overall issue, which is that fundamentally venture and innovation has become much more strategically important, not just to corporations but governments and populations. If you get this stuff wrong, then effectively the whole society can lose out and get bypassed. And we touched on it a little earlier, how relatively little goes into Europe. Europe has a vast number of large established corporations, home of the Industrial Revolution, but relatively speaking, it's an also ran for the next revolution, the sort of digital, let alone the quantum, and I think that's the sort of challenge is, a number of players, whether they're corporate or state, are saying we need to understand this area, and sort of perhaps the venture capital, independent firms, lifestyle businesses in many ways, as the route to providing the capital to those faster growing companies. It's not to all of them, and I think over the past 4 or 5 years, there's been that increase in recognition that that fundamentally the whole sector needed to shake up itself and become more professional. And people like yourself, Tony, have been banging that drum and doing the work for the BVCA more broadly to to show what is possible. And I think a lot of corporations are trying to catch up, and you just hope they move up the curve of their own experience and long-term support in order to provide the capital and support that the entrepreneurs fundamentally will need over the next few years.
Absolutely agree.
Okay, and then top investors, Bertelsmann, interesting big German corporation, very active in Asia in particular, but also Latin America and India, and obviously the US as well. Comcast, more traditional. Baidu, like the China's equivalent to Google as a search engine provider. Line, Japanese messaging service in many ways, and Bennett Coleman, a more traditional media group alongside Hearst, which has perhaps been transformed as well. And you mentioned Naspers, which was a legacy South African media group. Did pay TV, did newspapers, the national press as was. And they made a big bet a few years ago now, nearly 20 years ago, in taking a third or so of Tencent. Tencent's now a 500 billion or so market cap company with the WeChat platform. But Naspers obviously has had a phenomenal track record in Mail.ru and a whole host of other deals all around the world. So they've been a real powerhouse. And Slack and Dentsu. Slack obviously messaging service, new form, using, just as you described it, Tony, an ecosystem fund to try and support their messaging service. Free, much more games, and Dentsu a sort of media advertising player. And then by total dollars, Naspers reinvest in some of the capital. I think they sold 2% of Tencent last year and reaped something like 10 billion or so from that sort of percentage sale. So they've been reinvesting in other areas, and particularly in the e-commerce. And we'll come to that actually in a sector, because one of the things that I've been quite interested in is where do media companies reinvest, and this obviously looks in terms of the subsectors within the media sector that corporations have been backing. Obviously, if we look at the 2018 figures, the sort of majority were the gaming and esports sector. That's attracted not just media companies, but groups like Intel and a whole host of others, which are thinking of the way that these games can be played. Audio and video content, more traditional. Social media networks, obviously still remaining, and then sort of publishing and other media, sort of broadly, similar numbers at about 40 between the two. So anything surprising within that as you sort of look through the sort of subsectors, Tony? Anything catching your eye?
No, I think what is interesting is the amount of esports investments over the last 5 years. That's become really has become an emerging category.
Yeah, no, I think perhaps it talks to the sort of the online world, but I think something like 50 billion was spent in sort of games purchases online. So people are very much having their sort of virtual avatar, world, as well as the sort of in real life physical world. They'll read a newspaper perhaps, or look at a sort of Facebook news feed, or what the messaging service coming from WeChat, but actually they're spending as much time in many ways online as they are in real life IRL. And therefore the sort of games, esports, and value-added services within that is growing like a rocket. So do you see anything change in that, or do you think that's only sort of going to speed up as you get more virtual augmented reality coming through, Tony?
Yeah, I mean, I think that's seen very much as very much kind of an open border, and particularly seen the rise of things like Fortnite from Epic and others, which almost came from nowhere from even the gaming industry. And as each generation that comes through is born into an increasingly rich digitally native environment, and this generation that has only just been born, if you think just in near 10 years, they're going to become the primary motivators for consumer purchases for whatever generation of processing power plus bandwidth plus AR VR kit is available. I mean, it's very difficult to think that arrow of time gets reversed, and as we get into this era of multiplayer, very high density, very high graphic, very high narrative play that is increasingly real. You're alongside kind of some of the haptic developments that mean that a punch maybe feels like a punch, maybe it doesn't knock you out, but it definitely feels like you have been punched. You do start to get into an era that although we might be right at the beginning of this long journey that is going to be defined largely, I think, by the entertainment companies with vertically oriented stacks around whatever universe stroke software platform and hardware configuration that there is. It will definitely change the consumption of media again in a similar way that we've seen the consumption of media shift from print to digital, such that you couldn't imagine any 14-year-old these days having a subscription to a physical newspaper. That would be madness. Even my generation, it was reasonably madness to think a 14-year-old having a subscription to a newspaper, but at least we still read them. The next generation of media consumption is going to be wholly unlike anything that we're currently, I think, even conceiving, and that therefore you will constantly be experiencing a huge amount of innovation around pure engagement on an almost kind of reptilian basis of how humans respond to various forms of stimulus. And again, we come back to where we may get to one day with is there a role there to hold any of that back through regulation or otherwise. Time will tell again for that, but certainly what you've just described there, James, I'd absolutely subscribe to. I think the AR VR industry is in its infancy. I think that where AR and VR go first is strangely is either in entertainment, or strangely, as I said, in much more professional markets where the cost of deployment of those early handsets and so on can be absorbed by users that are getting a kind of a meaningful impact on their output, whether it's engineers or whether it's surgeons in situ or whatever, and simultaneously with a very broad distribution offers, whether it's a kind of a Magic Leap, you've got the name there, glasses that get rapidly adopted for a consumer price, or whether it's a vertically integrated device that Google may, or Facebook or Microsoft might offer down their channels to market. I mean, I think you're certainly going to see the entertainment market lead, but I have a suspicion that the more interesting stuff is going to happen in professional markets, where you're going to see a real change from human as being a consumer to being in collaboration with machines. We've hit this machine to machine era, and humans and computers and machines are now beginning to navigate and negotiate how they work together into the future. And that's where the machine is doing much more complex processing and the human's using its innate pattern matching, but then moving beyond that, of that simple handover to something that's far more enriched in a audio visual environment that the human is ultimately in control of. And I think we're going to see over the next 5 to 10 years rapid and massive advances in there. And at least that's some of our thesis of investing, is how you amplify the human through those kind of mechanisms. And in parallel, this next generation is going to be growing up in almost like a seamlessly virtual mix, high definition realities, the virtual realities that are almost boundless, these sort of open worlds which can be explored. Now, of course, that's not necessarily happening in next year or the year after, but certainly in the next 10 years, you're going to see the kind of same kind of transformation around that kind of personal experience with the VR handsets and handsets in the home, as we see maybe with the explosion of visual technologies on the flat screen in the cinema.
Yeah, fascinating. I think that sort of combination or collaboration between human and machine, to optimize decision making or responses, and how you sort of negotiate what the inputs are telling you and what you decide out of it. It feels a very sort of movable feast. And if you particularly look just on this slide on some of the big media deals, the media companies have invested in Epic Games. Obviously mentioned Fortnite as a whole open-ended world in many ways, new TV, sort of different form of content in some ways to being pushed out, short form video, and then Magic Leap, that sort of augmented or virtual reality sort of whole platform. So something came up on my LinkedIn feed today, and it was just how you can use Magic Leap to kind of do, in effect, conferencing. So rather than you look at a screen for a conference, it's like that person is in the room and you just set up your phone and a couple of cameras to go around. So we'll just leap through this. I'm mindful of time, Tony, and make sure there are any quick questions. But, in terms of exits, obviously, where the deals have been made is where some of the exits are. It's noticeable how few are in Europe, even though number of deals we're seeing less than 5% of investments coming out in terms of exits. Obviously a number of those, if you can get the exit, can be substantially valuable, in terms of where media companies invested, where they've exited, and then funding initiatives. Perhaps talking to your earlier point, we started to see, an increased number of new sort of CVC units, particularly from sort of 2014, getting towards sort of, double digits. New units, but then media corporations as a limited partner and venture capital funds focusing in that area. Obviously, the sort of the SoftBank Vision funds, particularly caught the eye in 2016. And then of those funds, number of them have been in China. If you look at the list, obviously the US remains, and a smattering elsewhere outside of one in Finland. Not much happening in Europe. And then universities, just very briefly, in terms of some of the spin outs that were coming from the universities, a lot of them have that sort of either the AI capacity or the haptics, things out of the University of Bristol and other places, and particularly Tsinghua and Peking universities, University of Tokyo, very strong, and and then sort of more traditional sort of games or ad tech marketing, those types of things. So that's a sort of quick review. Any final thoughts from yourself, Tony, in terms of the sort of exits and fundraising perspectives?
No, I mean, I think I would agree with a lot of those slides here around that agree with the kind of broad funding equation, and doesn't strike me as it's slowing down. It may well slow down if we hit a recession, but what it strikes me is that this process of reinvention is now taken root in every single industry. Every single industry is looking at a digitally native new set of players that are either using a regulatory arbitrage or a talent arbitrage or a talent technology arbitrage, or or some groundbreaking new capability to significantly challenge the traditional way of doing business. And so I don't think this is something that will suddenly disappear overnight if we get a slight market correction, as it almost happened in 2000, 2001. I think we are at the beginning of many decades of what we describe as how we think internally anyway, of digestion and deployment of technology across entirety of industries, as every industry reinvents to become an information and technology company.
Perfect. Well, I think that's a suitably sort of, I suppose, in many ways, optimistic point to end there, Tony. We'll close off the webinar at this point at the top of the hour. But yeah, I think we're the sort of one wave of a multi-generational, multi-decade sort of roadmap of change. So I really appreciate your insights, and be interested to see when Palantir and some of the other sort of big portfolio company successes, which we haven't really had too much time to talk through, Tony, come back to market. But it's been an amazing portfolio that you've built, so, and we've really appreciated all the advice and support. So thanks very much.
Thank you, James. Thank you, everybody.
Right, so that will be the end of the GCV Analytics Media webinar. The next one next month will be on healthcare, so do join us for that. And thanks again to Tony. Particularly wanted to say thanks to Kalyan Antonov for the preparation of GCV Analytics data, and Dan Stevens and the rest of the team at GCV for the webinar. Speak soon. Thank you.